right. Well, as you said, my name's Nolan Watson. I'm president and CEO of a company called Sandstorm Gold. For those of you who don't know much about Sandstorm, we're a streaming and royalty company, been around for a number of years. We built a fantastic team that we're very proud of. We built a business model we're very proud of, and over the years we've accumulated a portfolio of over 170 streams and royalties. Market cap is up to about $1.1 billion Canadian and continuing to grow. We're having lots of fun. But one of the things that we actually take pride in as a team is trying to be on the leading edge of some of the changes in finance. It was on a stage here at Minds and Money a number of years ago where I actually gave a speech about why mine finance, as you know, it is dead, and I was talking specifically about the streaming and royalty space, and at that time streaming and royalty companies only did streaming and royalties, and my speech was effectively saying that I believed that we were going to move as a group of companies to being in other parts of the capital structure as well. Obviously focusing on streams and royalties, but attempting to ensure that we could be part of debt syndicates, that we would be lead orders in equity financings. And I stand here today, and virtually every major streaming and royalty company in the world has moved their business model to that. And so we're very proud to be part of that leading edge change. And what I want to talk about here today is another topic that I believe is something that's happening right now. It's happening structurally. Permanent changes in the way equity is actually raised in our space, in the mining industry. And I think that this is something that some people are aware of, but a number of the factors that when you take a 10,000-foot view of how to raise equity and what's happening structurally in the market, you're starting to put this picture together of it's really hard to raise equity these days. I was talking with a banker a couple days ago who said it is scorched earth out there for junior mining companies trying to raise equity. And so for anyone who's here today or who's watching this on a video, if you're an investor in a mining company that's having a tough time raising equity, if you're a CEO of a mining company who's having a tough time raising equity, I think this talk is an important one. So the topic is, where did all the equity go? Three basic themes that I want to talk about. None of them take rocket scientists to figure out. None of them are groundbreaking. I'm just going to touch on them briefly, but the important point is putting it all together and understanding what's actually happening here. So the first is that capital is moving from active investors to passive investors. So before, when a CEO was trying to put an equity syndicate together, he could actually sit in front of an active institutional investor and try to convince him on the merits to invest in his mining company. Well, a lot of that capital has now moved into passive forms, into ETFs and index funds, that by their very nature, the definition of what they are, they cannot write an equity check into a financing. The equity's still there. It can invest in your company after you do the financing on a rebalancing, but it will not and cannot invest in the equity financing. And the second is that brokers and bankers are disappearing at a rapid pace. And partially because of technological change, the brokers are disappearing a lot faster than the bankers are. I think that the bankers are going to start dissipating, at least in their usefulness going forward, because of some of these structural changes and the availability of institutional equity, which is sort of their bread and butter, their go-to. And the third thing I'm going to talk about, and I've got a bit of empirical data for all of these, the third thing I'm going to talk about is that capital has moved to other parts of the capital structure. So whereas large funds, endowment funds, pension plans, sovereign wealth funds would have previously seeded active institutional equity investors, a lot of them are now putting funds into private equity firms. They're putting funds into streaming and royalty companies, and we're seeing the amount of capital in streaming and royalty companies around the world going up dramatically. So just to talk empirically about the first of those 3 points, so capital having moved from active to passive, I'm going to use Sandstorm's shareholder base as an example. You can see the light blue here. That represents the proportion of Sandstorm's investor base that is retail. Dark blue is a proportion that is institutional investors over time. And for the last number of years, we've been 40 to 50% institutional ownership, which is what you'd expect. And when you overlay what our market cap is, you can see we're close to a record market cap for Sandstorm, about $1.1 billion. And we're at that 50% institutional investor mark. The interesting thing, though, is when you reanalyze that same investor base by active versus passive, this is what it looks like. 4 years ago, 0% of our investor base was passive investors. It was all active. That means 4 years ago, if I as a CEO wanted to raise equity, 100% of my investors theoretically were eligible to be able to put money into the financing should they choose to do so. Today, fast forward 4 years later, 30% of my investor base is passive. And this is happening across the industry. That 30% cannot write a check into an equity financing. It is permanently gone, and it's not going backwards. This effect of capital moving from active to passive forms is just going to continue. I wouldn't be surprised if 5 years from now we see a situation where 40% of our investor base is passive and can't write checks into financing. So right off the bat, a lot of this capital is the old institutional investor capital that was active, that formed the lead order in an equity financing. That's gone, and it's never coming back. And the second point about brokers and bankers disappearing, obviously, historically on the retail side of an investor base, people had stockbrokers. And because of technological change, because it's a lot cheaper to just sit there on your laptop and for $6.99 you make trades rather than pay 1% to a broker, brokers' businesses are dying. Some of them are quitting. Some of them are being terminated. Some of them are moving into wealth management and are actually themselves now selling those passive investment products that are forcing capital to move into those investment products. We actually phoned a few weeks ago one of the major banks in Canada that has historically been one of the large proponents, especially in Vancouver and Toronto, of providing and organizing capital to junior mining companies. And we asked them the question, we said, 4 years ago, what % of your brokers are focused, at least 50% or more of their business, on mining? And when we got all the data, 2013 versus 2017, the number of brokers focused on forming capital for the purposes of equity financings in mining is down 78%. This is the mechanism the junior mining market used 4 years ago to raise equity capital. I think a lot of us have the belief, sort of this false narrative, that one of the reasons it's so hard to raise equity capital right now is because of things like, well, in precious metals, we got rising interest rate environment, people aren't really that bullish on gold, so it's hard to attract their attention, or because a lot of investors got burnt during the downfall of the last mining crash, and it's hard to get them to come back into it. The reality is, the mechanism that we use to get attention to a story and for an equity financing is broken. Those people are no longer employed doing that job. The equity's still out there. It's just a person sitting behind their laptop trading for $6.99 a trade, which is why you still do see high valuations in companies. There are companies out there like Novo that are getting incredible valuations off of little to no exploration, actual definitive drilling, because they're able to capture the attention and the hearts and minds of investors, and that capital is still flooding to them. It's just the mechanism to get equity into a financing is broken. If we go to the third point that I want to talk about capital having moved to different parts of the capital structure, it's not just a little bit of capital that's moving to different parts of the capital structure. It is a lot of capital. If you look at streaming and royalty companies in 2004, worldwide, this is for precious metals, total market cap of all streaming and royalty companies is really just one at the time, which is Wheaton Precious Metals, is $2 billion. Fast forward to 2011, near the top of the market, the capital allocated to streaming and royalty companies around the world in precious metals was $24 billion. Since then, we've had a massive pullback in commodity prices. Gold prices are down dramatically since this snapshot was taken. And yet, today, the combined worldwide market cap of streaming and royalty companies is $35 billion. So there's just huge amounts of capital that are moving into streaming and royalties. The same thing's happening on the private equity side. We just don't have the empirical data to prove it. And so between these three things, I just want to take this snapshot, or this 10,000-foot view of what's happening. We used to have a market where there was lots of active institutional investor capital that could invest and be lead orders in equity financings, and then we had retail brokerage that acted as the organizing mechanism to bring in the retail capital into those financings. And to be a good CEO for capital raising purposes, all you had to do is have good relationships with bankers and brokers. And that is not the case anymore. It doesn't work that way anymore. It's changed, and it's changed forever. And so what does that mean? What does that mean for our industry? Because mining is a hard business, and we've had a hard time as an industry making money for investors at the best of times, even when raising equity was easy. In fact, one of the implications of this, I think, is important to understand is mining companies that need capital and need it during the mine building process are going to have a harder time now raising that equity when they really need it. We did a study a number of years ago, which is totally outdated, and the conclusions are valid for that, but I'm just going to very, very quickly whip through this. We did a study of 68 companies. Only 14 of those companies actually delivered their mine on time. meaning 79% of the mines did not start up on time. Most of those mines overran in terms of the cost of getting the mine into production. And each of those mines gave guidance as to how much they were going to produce in the first year of production, call it X. That represents 100%. The actual production of the average of these 68 companies was 43% of what they thought it was going to be, which means intuitively 57% of your production is missing, so you're losing money. So what does that mean? Well, it means building a mine is hard. It takes longer than you think it's going to take, and it costs more than you think it's going to cost. And in your first year of operation, you lose more money than you thought you were going to lose. In fact, most companies think they're going to make money in their first year, but they don't. They lose money. So during this entire time, what are CEOs doing? They're putting out press releases that say things like, sorry, it's taking longer, problems with the crusher, we're getting it fixed, we're doing that. Oh, look over here, super sexy drill result and surprise and equity financing. And most of these companies had multiple surprise equity financings during the building and commissioning phase as they overran in capital. Now, we did a study of, the second part of it was what were the returns. Remember, this study was done in a rising commodity price environment, the best bull run in a number of years for mining. So the average company that had no debt in their capital structure had about a 73% return during this process for investors. If you had a little bit of debt, less than 10% of your capital structure, you still had a good return, 66%. As soon as you started to get into material amounts of debt, over 10% to 20%, that's when your returns dropped dramatically, because equity investors don't want to go behind debt when your mine's not working and you're trying to get it commissioned. And if you had more than 20%, forget about it, you're losing money. That was during the bull run. The interesting thing that I want to tie, the concept that I want to tie into this topic of equity is so hard to raise because of structural changes that have happened in global finance is, what is this chart going to look like 5 years from now in a stable commodity price environment where when the CEO needs to raise capital as a last ditch, can't? I'm willing to bet, gut feel, that it looks dramatically worse than this. And I think we're going to be moving into an era where CEOs who have strong backers financially for their project versus CEOs who are just relying on bankers and brokers are going to have dramatically different returns. These implications are not only for development companies or for exploration companies or for all junior mining companies. If you're an investor in this industry and you've invested in a CEO who is still conducting business on the equity side of things the way they did 5 years ago, you might be in for a surprise in terms of how much money you may lose as an investor. Oh, and by the way, this is just a chart for fun. Something that weighs on me quite a bit is the backdrop, the global financial backdrop isn't getting any safer. World debt to GDP ratios are higher than they have ever been in the history of the world ever. And if we get our next hiccup or whoopsie in a global economic sense, and you've invested in companies where CEOs don't have strong strategic relationships, it's going to be interesting. The conclusion of all of this is CEOs, we need to change the way we think about capital and raising capital and equity. This is one of the fun parts of my business. I believe that CEOs need to become the capital organizers. In fact, at Sandstorm, we've actually had a very fortunate happenstance situation. A number of CEOs have come to us over the last couple of years and have said, Nolan, I'm having a hard time attracting retail investors to my story. I just can't figure out how to do it. I put out good drill results and nobody cares. And so what they were asking us to do is do a stream or royalty with them, usually just a small royalty, $500,000, $1 million. And then they ask us to become their lead strategic equity investor, and so we'll buy 10% of their company in a financing. They'll use the funds to go drill. But then something interesting happens. We have 41,000 investors. If that company then does hit good drill results, there's immediately 41,000 new eyes on that story. And that causes success. We've actually seen a number of companies go from, when we do deals with them, $10 million market caps up to $100 million market caps if they get successful with the drill bit, because immediately there's 41,000 eyes on a story. So for me at Sandstorm, the next evolution of this, being on the forefront of this, I want our company, and I'm calling all CEOs to start thinking about this, we're going to be building a complete marketing department within Sandstorm in 2018. I'm not talking about IR. I'm talking full-blown marketing equity sales. And not just so that we can attract investors for our own purpose, but so that we can become a generator for other companies, an accelerator, if you will, so that if they do business with us and they have some success in the drill bit, that immediately they'll have huge and massive amounts of attention and we will help them organize capital. We want to fill that missing role for some of the brokers that are gone away. We want to help draw that attention, get hearts and minds of investors focused on successful stories, and have those investors make money investing in these companies. I think that all CEOs need to begin taking it upon themselves to replace that role that brokers used to in our organization, in our industry. One thing that I believe that all companies should do going forward because of these structural changes is they need to have strategic capital providers, and they need to do it in two tranches, both corporate strategics, so go try to get Goldcorp, AngloGold, Teck, Agnico, whoever it is, even mid-tier mining companies, get them as cornerstone investors. All of their investors will focus on your story as well. In addition, at the same time, you can have strategic financial providers, the private equity firms, the streaming and royalty companies. These things aren't mutually exclusive. They can be done at the same time. And I think that in the world as it goes forward, with the structural changes that have happened, with equity having moved from active to passive, with brokers and bankers going by the wayside, with capital being moved out of equity into other parts of the capital structure, this is going to be the new norm. Successful companies will have strategic partnerships with mining companies and with capital providers, and they will get the attention of the investors of those strategic partners. That's actually one area where I do believe Sandstorm has a competitive advantage of, and that's one of the reasons I want to maximize it with this whole marketing equity sales concept, is because if someone does a deal with a private equity firm, the private equity firm brings capital, but it doesn't bring 41,000 eyes, and it doesn't bring the hearts and minds of a whole group of investors if the mining company actually is successful. So moving forward, I think that we need to change the way we think about equity. We need to change the way we think about raising capital as an industry. I think it's going to impact all of us as investors. I spend a lot of time investing my own personal money as well in the industry. It's something that I spend a lot of time thinking about. I can tell you that I will not be investing either Sandstorm's money or my personal money in a mining company if the CEO does not get the concepts of how this equity market has changed. But having said that, there still is a lot of equity out there. There still are a lot of retail investors wanting to invest in things. The key is just finding mechanisms to actually coalesce those so that they come into equity financings. If you can attract the heart and minds of investors, you can still get great valuations in this industry. Investors can still make a lot of money. And so I'm excited about this. I think it's going to provide a lot of opportunity for investors who understand what they're doing, that understand these concepts to make money. I think it's going to provide a lot of opportunity for streaming and royalty companies to make money. But I think it's a chance for our industry to grow and to learn and stretch past the typical ways that we've raised capital in the past, to get better at raising equity and to get better at just the relationships that we have with our equity investors. Having a much more direct communication link between CEO and investor, I think, is a good thing for our business. I think it's a healthy thing for our business. I'm excited to be on the forefront of it and part of it. And that's all I have to say today. But thanks very much for coming, and I'll see you guys around. I'll be here for questions if you have them.